Every major financial cycle begins with a question. And almost every time, the first question people ask is the wrong one. With artificial intelligence, that question sounds familiar. Is this another dot-com bubble? The assumption behind that question is subtle but dangerous. It assumes that bubbles are defined by technology, that if the technology is real, useful, or already generating revenue, then the historical pattern no longer applies. But financial history has never worked that way. The dot-com crash was not the failure of the internet. The internet did not disappear after 2000. In fact, it went on to become the backbone of the modern global economy. What collapsed back then was not technology. It was the way capital was deployed in anticipation of technology. And that distinction matters far more than most current discussions about AI are willing to admit. When people compare AI to dot-com today, they tend to focus on surface signals, stock prices, startup valuations, media hype, but systemic bubbles are rarely visible at the surface. They form deeper where capital moves first, long before profits arrive, long before productivity catches up, and long before expectations are forced to confront reality. If we look at AI through that lens, the real question is no longer whether the technology works. The real question is whether the behavior of capital around AI is repeating something we have already seen before. To answer that, we need to revisit what the dot-com era actually was, stripped of nostalgia, stripped of caricature. In popular memory, dot-com was a time of flimsy websites, unproven business models, and irrational exuberance. But beneath that narrative sat a far more important dynamic. The late 1990s were defined by a massive build-out of infrastructure ahead of demand. Hundreds of billions of dollars flowed into fiber optic networks, data centers, servers, and telecommunication systems. Much of it financed years before meaningful cash flows existed. The logic was simple: build first, monetize later. And the logic was not entirely wrong. What proved fatal was not the direction, but the timing. Infrastructure scaled far faster than cash flows. Capital was committed long before revenue could justify it. And once the gap between investment and return became too large, the financial system lost patience. Dot-com did not collapse because the internet failed. It collapsed because the rate of capital deployment exceeded the rate of economic absorption. When the bubble deflated, companies vanished and valuations reset. But the infrastructure remained. That infrastructure would later support Google, Amazon, Netflix, and the entire digital economy that followed. Dot-com was not a technological mistake. It was a capital allocation mistake, misaligned in time, scale, and expectation. And that is precisely where the comparison to AI becomes uncomfortable, because AI today is clearly not a repeat of dot-com. At the technological level, AI systems already work. They already have users. They already generate revenue. They are deeply integrated into the largest corporations on earth and increasingly tied to national strategy. This is not a fringe experiment. This is core economic infrastructure in formation, and that is exactly why many people conclude this time is different. In one sense, they are right. AI does not need to prove that it exists. It does not need to prove that it can be useful. But that truth has created a dangerous blind spot, because the largest bubbles in history rarely sit where attention is focused. They sit where commitments are made, quietly, structurally, and at scale. In the AI cycle, the bubble is not in software demos or consumer applications. It is not even primarily in equity valuations. It is in physical infrastructure, and more importantly, in corporate balance sheets. Unlike dot-com, where excess often showed up as inflated stock prices, the AI boom expresses itself through capital expenditure, data centers, energy contracts, water usage, long-term supply commitments, multi-year leasing structures. These are not speculative assets that can be exited overnight. They are fixed, capital-intensive, and slow to reverse. This is where the scale of the current cycle becomes apparent. Global AI spending is already projected to exceed $300 billion annually. In the near term, surpass $500 billion before the decade ends and approach $2 trillion per year by 2030. Simply to sustain the infrastructure being built today. At that level, AI infrastructure spending alone begins to rival, and in some projections exceed, the combined annual revenues of the world's largest technology companies. Only a decade ago, AI infrastructure spending is no longer a technology investment, is less than #0. 4# is greater than, it resembles national-level industrial build-outs. The question is no longer whether AI will be used, but whether the returns generated by AI can arrive fast enough to justify the capital already being locked in place. And here, the comparison with .com becomes not only valid, but conservative, because the AI cycle is not just larger. In absolute dollars, it is more concentrated, more interconnected, and more financially reflexive. Major technology firms are no longer just builders of infrastructure or providers of services. They are simultaneously investors, customers, suppliers, and revenue counterparties to one another. Capital circulates within a closed loop. Money invested becomes revenue. Revenue justifies valuation. Valuation supports further investment. On paper, everything grows. This reflexive loop makes the system appear stable, even self-reinforcing. But history shows that such systems do not break suddenly at the top. They erode from below as returns fail to materialize at the speed required. What makes the AI cycle especially significant is that it has been financialized from the start. Infrastructure commitments are already being packaged, leased, securitized, and distributed across the broader financial system, reaching bond markets, pension funds, and long-duration credit vehicles long before the profitability of AI workloads has been conclusively established. .com did this after the crash. AI is doing it in parallel with expansion, which means the question is no longer whether AI will burst like a classic bubble. It doesn't need to. A prolonged mismatch between capital invested and cash generated would be enough. Delayed returns, write-downs, capital expenditure slowdowns, tighter credit conditions. History shows that these quiet adjustments can be more damaging than dramatic collapses because they drain momentum from the entire system over time. This is why the most accurate comparison to .com is not technological, but behavioral. AI today is not repeating .com's technology. It is repeating almost precisely .com's capital behavior, and doing so at a larger, more systemically embedded scale. And history is clear on one point: technological progress is rarely punished. But financial systems that overcommit capital to future cash flows before those cash flows exist almost always are. If the .com era taught markets anything, it is that bubbles are not defined by optimism alone. They are defined by scale. And this is where the comparison between AI today and the .com boom begins to shift from familiar to unsettling. In the late 1990s, capital flooded into software companies, websites, and telecom startups that promised a digital future. The spending was aggressive, but it was also relatively light. Servers were small, power usage was modest, infrastructure was limited, and much of the capital stayed confined within equity markets. Today's AI cycle operates on a completely different physical and financial plane. Global spending on artificial intelligence is already projected to exceed $300 billion annually, rise beyond $500 billion within the next 2 years, and approach $2 trillion per year by the end of the decade, not to expand demand, but simply to support the infrastructure now being built. That number matters because $2 trillion a year is not venture capital, it is not speculative funding, it is industrial scale capital. At that magnitude, AI spending begins to resemble national infrastructure programs rather than a technology cycle. This is not capital chasing code. This is capital reshaping the physical economy. Modern AI is not just software, It is data centers, the size of small cities. It is custom-designed chips with multi-year supply contracts. It is power stations, water rights, grid upgrades, and industrial-scale construction. In many regions, data centers have become the only segment of commercial construction still accelerating, while offices, retail, and residential development slow or contract. This alone distinguishes the current cycle from .com. .com was speculative capital layered on top of an already functioning economy. AI capital spending has become a primary driver of economic activity itself. Multiple analyses suggest that without AI-related investment, recent economic growth would have been close to zero. GDP expansion, corporate earnings growth, and equity performance have become disproportionately dependent on one spending cycle. That is not diversification. It is concentration. And concentration is what turns optimism into fragility. The scale problem is not just how much money is being spent. It is how fast, how synchronously, and how irreversibly it is being committed. Once a data center is built, the capital is sunk. Once power infrastructure is upgraded, it cannot be redeployed. Once long-term chip supply agreements are signed, they must be honored, regardless of demand. This introduces a structural asymmetry that did not exist during the dot-com era. In the 1990s, when expectations collapsed, startups disappeared and servers were written off. Office parks sat empty. Capital losses were severe, but the system absorbed them over time. In today's AI cycle, the assets are heavier, the financing longer dated, and the dependencies broader. Energy companies are expanding generation capacity specifically for AI workloads. Utilities are raising rates to finance grid upgrades. Construction firms are racing to retrofit industrial facilities into data centers because speed now matters more than efficiency. As several executives have admitted openly, time is no longer an ally. It is the constraint. And all of this is happening before the core question of profitability has been resolved. Despite record-breaking valuations, many of the most prominent AI developers continue to operate at a loss. Each incremental use of advanced AI systems consumes compute, electricity, and capital at a pace that revenue has yet to fully offset. Break-even timelines are measured in years, not quarters, and they depend on assumptions about future pricing power that remain untested. This does not mean AI lacks value. It means the capital structure is ahead of the cash flow. That is the echo of .com, not in technology, but in timing. Then, as now, infrastructure was built in anticipation of a future that was real, but arrived more slowly than investors expected. Fiber optic networks eventually became the backbone of the global internet, but for years, they sat underutilized, depressing returns and straining balance sheets. The same dynamic is now visible in AI. There is a widespread belief that even if excess capacity is built today, it will eventually be absorbed. Historically, that belief has often proven correct, but markets do not price eventual usefulness. They price near-term returns, and this is where scale begins to matter in a more dangerous way, because the larger the capital commitment, the smaller the margin for delay. In the dot-com era, speculative losses were largely contained within technology stocks. Today, AI spending is deeply entwined with utilities, real estate, credit markets, and public infrastructure. Pension funds, retirement accounts, bondholders, all increasingly exposed, not just to AI companies, but to the physical ecosystem built around them. This transforms a technology cycle into a macroeconomic one. When investment itself becomes the growth engine, any deceleration, however modest, produces outsized effects. A slowdown does not need to resemble a crash. It can appear as deferred expansion, slower leasing, or tighter financing conditions. But because so much economic activity now depends on continuous AI investment, even a pause, can ripple outward. This is why the scale of the current cycle matters more than whether AI works. .com failed because expectations outran reality. AI does not need to fail for a similar outcome to emerge. It only needs to mature more slowly than capital demands, and when capital builds faster than cash flow can justify, the system does not collapse instantly. It stretches, valuations compress, returns normalize, narratives shift. The question, then, is no longer whether AI resembles .com. The question is whether the financial weight of this cycle has reached a point where even a successful technology can strain the system built to support it. And that brings us to the next issue, one that history repeatedly warns about. Because when cycles do not end in spectacular crashes, they often end in something quieter, but no less consequential. A prolonged adjustment where capital discovers, slowly and painfully, that scale does not guarantee safety. That is where we turn next. When people talk about bubbles, they usually imagine a single moment, a collapse, a headline, a sudden loss of confidence. But history suggests that the most consequential financial cycles rarely end that way. They end through friction. The .com crash is remembered for its speed, but what truly defined its aftermath was duration. Years of stagnation followed the initial sell-off. Capital was not destroyed overnight. It was slowly repriced. Balance sheets adjusted. Expectations were forced back into alignment with cash flow. The same dynamic is far more likely in the AI cycle. This system does not need to fail. It only needs to slow, and that distinction matters. Most of today's AI spending is not discretionary, it is contractual. Long-term data center leases, multi-year chip supply agreements, energy purchase commitments, infrastructure financing structures that extend far beyond quarterly earnings cycles. These obligations assume continued expansion, not exponential growth, but steady, predictable growth. If demand merely grows more slowly than expected, pressure begins to accumulate. The first signs would not appear in consumer products or public narratives. They would surface quietly, where stress always appears first, on balance sheets, deferred build-outs, renegotiated leases, lower utilization rates, longer payback periods, higher financing costs. In financial systems, stress rarely announces itself. It reveals itself through timing mismatches. Capital has been deployed rapidly, but returns remain backloaded. Despite unprecedented investment levels, many AI companies continue to burn cash. Data center operators remain profitable only at high utilization thresholds. Utilities have front-loaded capital spending based on forecasts that assume sustained, uninterrupted growth in AI demand. This creates a narrow corridor in which conditions must remain favorable, not perfectly, but consistently. History shows that corridors like this are fragile. The .com era did not collapse because the internet failed. It collapsed because capital structures assumed timelines that reality could not meet. AI faces a similar risk, but with a critical difference. This time, the cycle is deeply intertwined with credit. Large technology firms are not only spending retained earnings, they are issuing debt. Infrastructure expansion is increasingly financed through bonds, leases, and structured instruments designed to distribute exposure across the financial system. These mechanisms are efficient until growth assumptions shift. When growth is strong, leverage amplifies returns. When growth slows, leverage amplifies vulnerability. This does not require a recession. It does not require panic. It requires only a change in assumptions. If interest rates remain elevated longer than expected, refinancing becomes more expensive. If investor enthusiasm cools, valuations compress. If AI adoption progresses more gradually than optimistic forecasts suggest, utilization rates fall. None of these outcomes are catastrophic. on their own. But together, they change behavior. Executives delay expansion. Lenders tighten terms. Investors demand clearer paths to profitability. Capital becomes selective rather than abundant. That is how cycles turn, not through collapse, but through restraint. And restraint is dangerous for systems built on momentum. During the dot-com unwind, companies did not disappear all at once. Many survived, but their valuations took years, sometimes decades, to recover. The technology endured. The capital structure did not. The AI cycle is likely to follow a similar path. The strongest firms will persist. The infrastructure will remain. The technology will continue to evolve. But valuations, financing models, and expectations may need to adjust downward to reflect a slower, more incremental reality. This is not a failure of innovation. It is a failure of synchronization between capital and time. The more a system depends on continuous investment to sustain growth, the more sensitive it becomes to any pause. And the larger the scale of the system, the smaller the margin for error. This is why the risk in the AI cycle is not a sudden pop. It is a prolonged recalibration, a period where capital learns, again, that even transformative technologies do not escape financial gravity. And when that recalibration begins, the question is no longer about technology. It becomes about who absorbs the adjustment, because history is consistent on this point. The technology survives, but the burden never distributes evenly. That is where the next phase of the story begins. When financial cycles recalibrate, the most important question is never whether technology survives. It almost always does. The real question is where the cost of adjustment lands. In the dot-com era, the damage was initially concentrated in equity markets. Share prices collapsed, venture capital evaporated, office parks emptied. Over time, the broader economy absorbed the shock, and the internet quietly became indispensable. The AI cycle is structurally different. This time, capital is not only embedded in stocks, it is embedded in credit, infrastructure, and everyday economic life. Large technology firms can absorb disappointment. Many generate hundreds of billions of dollars in annual revenue and collectively hold trillions in cash and near-cash assets. If AI returns underperform, these companies can write down investments, slow expansion, and preserve margins. Their balance sheets are designed for error. The system built around them is not. Data center operators rely on multi-decade leases. Utilities commit to grid upgrades with timelines measured in decades, not quarters. Construction firms scale capacity based on continuous project pipelines. Bondholders price risk assuming stable, predictable cash flows stretching far into the future. Pension funds and retirement systems depend on valuations that do not fluctuate violently. These actors cannot pivot quickly. Their capital is illiquid, long-dated, and politically visible. This is how a technology cycle becomes a systemic exposure without ever announcing itself as one. The dot-com bust erased speculative equity capital. The AI cycle risks redistributing strain across the real economy. Signs of this redistribution are already visible. Despite record levels of AI-related investment, broad economic momentum remains uneven. Employment growth is concentrated in government, healthcare, and low-productivity services. Private sector hiring tied to innovation is selective and cautious. Consumer spending increasingly depends on higher income households, while real wage growth for the median worker remains subdued. Asset owners benefit from rising valuations. Wage earners see little structural improvement. This divergence matters. When capital-driven growth masks underlying fragility, the system enters a narrow equilibrium. The economy appears strong, but only as long as investment intensity remains high. If AI spending slows, even modestly, the illusion does not need to collapse. It only needs to fracture. Corporate confidence softens. Hiring pauses rather than reverses. Credit conditions tighten incrementally. Consumer sentiment weakens at the margins. None of this requires panic. It requires hesitation, and hesitation propagates quickly in systems built on expectation rather than realized cash flow. This is why comparisons to the dot-com era often underestimate present risk. Dot-com optimism inflated equity prices. AI optimism is inflating economic structure itself. Power grids are being redesigned around projected AI load, water systems are being allocated to support data center density, cities are rezoning land based on assumed long-term demand. Financial products are being created to monetize decades-long data center leases and infrastructure revenues. These are not reversible decisions. Once capital reshapes physical reality, adjustment becomes slower, more political, and more uneven. Losses do not disappear. They migrate into higher costs, delayed projects, public balance sheets, and reduced flexibility. This is where the employment narrative enters. AI is frequently framed as a productivity miracle, a labor-saving force that will retroactively justify today's investment. Yet measured productivity gains remain modest relative to the scale of capital deployed. Adoption is uneven. In many organizations, AI adds layers of oversight, verification, and coordination rather than removing labor entirely. Still, the narrative persists, because narratives are not designed to describe reality. They are designed to sustain capital allocation. During dot-com, the promise was frictionless commerce and infinite scalability. During AI, the promise is automation, cost reduction, and eventual dominance. Both narratives perform the same function. They allow capital to tolerate present losses in exchange for imagined certainty in the future. When that future arrives slowly, the cost does not vanish. It shifts. Workers face more precarious employment. Infrastructure users face higher prices. Public systems absorb fiscal strain. Investors revise return expectations downward. Growth decelerates not because the technology failed, but because capital overshot. This is the quiet aftermath of bubbles. Not collapse, but compression. Compression changes behavior long before it appears in financial charts. Executives become cautious. Spending turns selective. Expansion gives way to optimization. The conversation shifts from how fast to how sustainable. This is not the end of AI. It is the end of the phase where capital believes it can outrun time. Which returns us to the central idea. AI today is not repeating dot-com in technological ambition. It is repeating dot-com in capital psychology. The belief that scale guarantees inevitability. The belief that money creates certainty. The belief that infrastructure secures returns. History is unkind to these beliefs. As capital relearns this lesson, the most important outcome will not be who wins the AI race. It will be how the system absorbs the realization that even the future must obey financial gravity. What history teaches us is not that technology repeats itself. It doesn't. Railroads do not return. The internet does not reboot. Artificial intelligence will not disappear the way dot-com websites once did. What does repeat with unsettling precision is how capital behaves when uncertainty meets promise. The AI boom is not dangerous because the technology is fragile. It is dangerous because capital is behaving as if certainty already exists. Money is moving faster than understanding. Valuations are expanding faster than cash flows. Narratives are traveling faster than balance sheets. This is not a judgment about what AI will become. It is an observation about what belief looks like right now. In every major cycle, capital reaches a point where it stops asking how value will be created and begins assuming that value is inevitable. That moment is never defined by technology. It is defined by behavior. When funding concentrates before revenue appears, when infrastructure is built faster than demand materializes, when optionality is priced as certainty, when skepticism is dismissed as ignorance rather than caution, that is when systems become fragile, not because innovation failed, but because expectations detached from time. And when time reasserts itself as it always does, capital does not vanish. It repositions, it consolidates, it abandons excess and preserves what proves useful. This is why bubbles are not the end of progress. They are the price paid to discover where reality actually lives. After the dot-com rupture, the internet didn't disappear. It became quieter, cheaper, less mythologized, and more essential. After the AI cycle recalibrates whenever and however that occurs, the same pattern is likely to emerge. Fewer companies, more durable infrastructure, lower noise, higher utility. History does not punish innovation. It punishes mispriced certainty. And so the lesson of AI today is not about prediction. It is about recognition. Not asking what AI will become, but asking what capital already believes it is. Because in every cycle, technology shapes the future, but capital reveals the present. And right now, capital is speaking very loudly, not about intelligence, but about belief.